Short exercise 6-6. We're going to learn about using the weighted average inventory costing method to figure out how much our inventory costs us whenever we're selling it, so we can calculate cost of goods sold. So this is the fourth inventory costing method that we're learning about. The others being specific identification, which is not used very often, and FIFO and LIFO. First in, first out, and last in, first out. Now remember, a company is just going to pick one of these inventory costing methods for the inventory costing. They're not going to jump around like we've been doing in these problems. These problems that we've been doing recently are just showing us how these different inventory costing methods work. So we're going to prepare Montana Cycle's perpetual inventory record, assuming they use a weighted average. Start by entering the beginning inventory balances, which are up here. They started with 25 bicycles that cost $36 each. 25, 36, you do the math, 25 times 36 is 900. So we started the month with $900 of inventory. And then on July 16th, they bought 35 bicycles at $60 each. So 35 at 60, we do the math, that's 2,100, same as in the other problems. Now, because they're using the weighted average method, they're only going to have one layer of inventory. And then what we do with that layer is we figure out the weighted average cost. So here's how we're going to figure out the weighted average cost. First thing, we're going to calculate the quantity. We had 25. We purchased 35 more. You add those together, that gives us 60. Now we're going to skip the unit cost because we calculate that last. Now we're going to calculate total cost. That's $900 plus the $2,100 over here gives us $3,000. So now what's the average cost if it costs us $3,000 and we have 60 of them? So we're going to take $3,000 divided by 60. That gives us an average cost of $50 per unit. Then on July 31st, according to this data up here, we sold 33 bicycles at $105 each. So under cost of goods sold, we have to enter the amount that we sold. So we sold 33. And what is the unit cost? Well, we just go up to the previous layer right here, and it's 50. So we're just going to copy and paste that. So 33 bicycles that we sold at an average cost of $50 each. So 33 times 50 gives us $1,650. So our cost of goods sold for that sale is $1,650. So hopefully we sold it for something at a lot greater amount than that. Now we need to calculate our remaining inventory. So we're going to start with this. Start with the quantity. We had 60. We sold 33. So to find out how many we have, we're just going to subtract those two. We have 27 bicycles remaining. And the average cost is still 50. So now we just need to calculate the total cost of 27 times 50. 27 times 50 gives us a remaining inventory value of $1,350. Now the $1,350 means that's how much those remaining bicycles cost us. Now we're going to calculate the totals. The amount purchased is 35. The total cost was $2,100. Copy that, paste it. How many did we sell? We sold 33 for a total of $1,650. Copy and paste that. Now the remaining inventory on hand, we just look at the last layer. So we ended with 27 bicycles. That cost us $1,350. So if your boss asked us what's our remaining inventory, the value is $1,350 and the quantity is 27. That's the remaining inventory. If your boss asked you how much we sold 33 quantity-wise, and that cost us $1,650. How many did we purchase? 35 at a total of $2,100. Now we're going to journalize those same transactions we journalized in the other transactions, or excuse me, the other previous exercises. Journalize the July 16th purchase of inventory. So on July 16th, we purchased $2,100, so I can copy and paste that from my debit and credit. Inventory is going up, so that's the debit. Accounts payable is going up, so that's the credit, because we bought it on account. The explanation is to purchase inventory on account. Now we're going to do the sale. July 31st, do this, journalize the sale of merchandise inventory on account. Do not record the expense yet. Do that in the next transaction. So since we're selling it on account, we have to calculate AR. So we are receiving accounts receivable. And how much did we sell it for? Right up here, 33 times 105. I should have memorized that from the other previous exercises, but I did not. So $34.65. So our customers owe us $3,465. And the credit is sales revenue increasing. To record sale on account. And then lastly, we need to record cost of goods sold. COGS is going up. COGS is an expense. Our inventory is going down. So that is why we are crediting it, because assets go down with the credit. Now, how much did that inventory cost us? We can click here, but if it's on the test, this link is not going to be there since it's an answer. So we're going to scroll up here, and our cost of goods sold on July 31st was $1,650. Copy and paste that down here. Record cost of goods sold. So each company gets to choose which inventory costing method they're going to use to keep track of their inventory. And if you notice, the cost of goods sold will vary depending on the method that they use. The different inventory methods will affect expenses, which will then affect net income. Also, it affects the ending value of inventory. So it affects the balance sheet. But in the long run, all these differences will even out over time. And that's it.